Hello and welcome back to Life Beyond Trends, where we simplify the complex world of investing for you. In today's video, we're diving deep into the whirlwind of the 2024 markets. Stick around as we try to understand the reasons behind these drastic fluctuations. Before we start, if you're new here, consider hitting that subscribe button and turning on notifications so you never miss out on crucial market insights. Let me start with a question. Have you ever felt like the stock market is just taking you on a wild ride, unpredictably swinging up and down, leaving you scratching your head? Well, you're not alone. Let's face it, the market has been acting like a yo-yo since January 2024, showing us highs and lows that seem almost erratic. But what's really behind these shifts? Is the market just playing games with us, or are there solid reasons behind this volatility? Let's dig into some key factors impacting global and local markets. Let's start with the Federal Reserve, the puppeteer pulling the strings of our economy. As we speak, all eyes are on the Federal Reserve, with investors hanging on to every piece of news about potential rate cuts. Speculation runs high as we await their decision on interest rates. The initial speculation was a rate cut would be in March 2024. It came down from 80% to 20%. However, we are now still determining if June is the new date. That probability is now considered at 85%. With the Fed meeting around the corner, the big question is, will they, won't they? But why the uncertainty? It is anyone's guess. I feel the rate cut boils down to the resilience of the US economy. Strong job markets and robust economic data influence the Fed's decisions. The US economy, a behemoth in its own right, flexes its muscles with robust data and strong labor markets. And when the economy thrives, why would the Fed rush to lower rates? US 10-year Treasury yield bond increased to 4.1%. In its recent Monetary Policy Committee, RBI kept the repo rate unchanged at 6.5%. With easing inflation, the repo rate could be slashed soon, but that's a guess. Tell me, what are your thoughts on their latest moves? Are you expecting a rate cut, or will they hold steady? Now, what does all these mean for you as an investor? Let's find out. Diving into specific sectors, we've noticed some intriguing patterns. Looking closely, the indices reflect a generalized downturn. The small and mid-cap segments have shown remarkable resilience, with growth of nearly 4% and 2.5% as of January. But is all that glitters really gold? Nifty and Sensex, our trusted barometers of market sentiment, have been on a downward trajectory. Market sentiments have turned negative in the near term. If we look into the banking, finance, and FMCG sectors, they tell a different tale, hinting at underlying economic narratives. Is the slowdown in rural demand a precursor of broader economic woes? Could it reflect underlying weaknesses in key sectors? Please share your thoughts in the comments section below. The banking sector, one of the prime drivers of Indian indices, is under pressure. Deposits are dwindling, and NPAs are showing indications of rising. From deposit pressures to NPA concerns and the RBI's keen eye on banking advances, we've got some sense of what's really happening beneath the surface. The recent banning of Paytm banking services has also dented market sentiments. Investors should be wary of Bank Nifty being down by 7.1%. Before continuing with the topic, make sure you've hit the like button below if you've been enjoying this so far. Also, please leave a comment and share it with your contacts, followers, or anyone you think may find this useful. We recently concluded the interim budget. On the expected line, no major announcements could change the sentiments in the recent market. There were no populist measures that could potentially dent market dynamics. As we eagerly await the elections and subsequent budget in the next few months, speculation on potential market impacts is rising. Investors still keep higher expectations for any upcoming budget. Will tax exemptions rise? Could STT be on the chopping block? Or will the market shrug off these announcements as inconsequential? The only certainty in these uncertain times is volatility. With elections looming, investors brace themselves for a bumpy ride. RBI has recently predicted that the inflation target for FY25 would be around 4.5%. It is down a bit but still above 4%. A rate cut would be definitely welcomed by the market. Recent indicators show that food production, especially the winter crop, has been better than expected. The last monsoon was a dry spell due to the El Nino effect, and speculation was of lower farm produce. However, even with lower water reserves, food production has gone relatively well. This could fuel rural demands in the near term and increase consumption. FMCG sectors could see an increase in sales. I am keeping my fingers crossed. India Inc. Numbers have been announced recently. For the December quarter, 60% of results are positive. However, mid-caps and small caps are unlucky at 53% and 45% respectively. Of all announcements, 58% of stocks have negative or flat trends. India Inc. Its net profit declined by 1.8% quarter-on-quarter but increased by 31% year-on-year, with sales growth at 5.6%. Earnings growth for the year may be under pressure due to the global economic slowdown and increased freight costs. But amidst the uncertainty, plenty of opportunities are available for those who are patient enough to seize them. There are good quality equities that have good price points. Do you want to know how to figure them out? Please let me know in the comment section. So, how should investors navigate FY24? One must watch out for fundamentals before investing. Speculative buying of momentum stocks for short-term gain can lead to losses. With economic sluggishness in the US and European markets, it is better to wait and watch before investing in export-oriented sectors. Domestic-focused sectors can be a better bet. I prefer investing in small intervals to beat volatility in the equity market. How about you? Please comment. Recently, RBI revised the GDP rate growth forecast for FY25 to 7%. This is indeed a good indicator for better days ahead. As we navigate these choppy waters, let us remember the words of Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. So there you have it, a roller coaster start to 2024 with more twists and turns expected ahead. But remember, knowledge is power. Understanding these dynamics can help you confidently navigate the uncertain waters of investing. Do you agree with our analysis? Drop your thoughts in the comments below. And if you found this video enlightening, give us a thumbs up, share it with fellow investors, and subscribe for more insightful content. Until next time, keep your investments savvy and your outlook broad.